Hello everyone and welcome to this week's FX update. My name's Craig Erlam, Senior Market Analyst at OANDA. This week is an extra special FX analysis update because this week I am joined by my colleague over in New York, Ed Moya, who is on as a panelist now. If you want to say hello, Ed.
Good morning, everyone. Good afternoon, Craig, and great to be on.
So yeah, hopefully you guys will get some of the benefit from some analysis and the viewpoints of everything that's going on from across the pond. Naturally, right now, actually, one of the key themes that we're seeing right now in the markets playing out surrounds Brexit. So I think it's always worth getting some extra perspective, really, from people that aren't in this country, that aren't breathing this in, day out, and in many cases, including my own, completely drowned by the sheer amount of news and rhetoric. But first, as always, we will start with a look at the economic calendar, see what events we have lined up for the week ahead. We'll then push on with the charts, and we'll cover some of the more macro topics, including Brexit, as we push through with the charts. As always, please do feel free to ask any questions as we go. If we can't answer them during, we'll try and touch on them at the end. This is a shorter webinar than the one we conducted last week, which was an hour session with myself and Dean, but we will try and get through as much as we possibly can. Hopefully, on the screen in front of you right now, you'll see the OANDA MarketPulse website. This is where we post all our content on a day-to-day basis, so you can see a selection of stuff covering a variety of topics and instruments that's been posted over the course of today. But it's also where you find the economic calendar, which is what I have open on the tab right here. One I prepared earlier, as they say, with just the currencies which affect the charts which we're covering, as well as and only the upper tier. So we filtered it by medium and upper tier events. And like I say, this week it is very much macro political dominated, which has been broadly the theme for quite some time now, it seems. The data is still having intraday impacts, but compared to the broader macro theme, we are seeing it really getting quite overshadowed to a great extent. So we had like the CPI data from China over the weekend. There was very little noise about that, if I'm being perfectly honest, at the start of the week. Yesterday very much overshadowed the Brexit situation, very much overshadowed things like the GDP data, which was weaker on a year-on-year basis than what we had previously, suggesting that we have had a soft October, as you can see here from the monthly data. But the manufacturing and industrial production as well, equally not as good. This morning's jobs report was actually quite decent, which is potentially a little bit surprising. Average hourly earnings is one of the things that has been one of the beneficiaries, I guess, from the Brexit vote. I guess when taken in singularity, that is the case. But of course, when we look at the broader picture of higher inflation as well, real earnings have still been very low. We are just starting to see a recovery here. So I do think a certain proportion of this has been driven by the fact that we have seen inflation rise, so therefore people demand more money on this annual basis. And granted, there will be an element as well of a tight labour market, and with more and more or fewer and fewer from a net perspective, people coming to the UK from the EU, that is going to be taking its toll as well. Pushing through the week, we've got some US inflation data, and I think this is going to be particularly key because we do have the Fed meeting next week. That expectations have really changed ahead of this meeting. I think only a week and a half ago we were looking at plus 90% plus probability of a rate hike being priced into the markets, and that's slipped quite dramatically. Initially, it was just future rate hikes that were slipping, but it's really taking its toll on December now. And I think this is probably a good point to bring in Ed, actually, because what's your view? Is this caught you off guard how much December has been not necessarily priced out, but so the probability of it being priced in has slipped so much?
Yes, and when we take a look at the probability, it has really had major swings in the last several days. We were below 70%, and currently right now the chances for that December hike are at 74%, and everyone, is just taking into consideration the softer data that we are expecting. You were highlighting the calendar today, so just taking a look at expectations for CPI, everything's expected to come down. The month-on-month reading expected to come in flat. That prior reading was 0.3%. Year-on-year also expected to tick lower. And when we take a look at some of the other data later on in the week, retail sales expected to decline. Today we have PPI, which is also expected to come in lower. So all this softer data is starting to weigh in. And as we were looking at, the market was pricing in 2 hikes next year. The Fed, their dot plot was suggesting December hike and 3 hikes for next year. So ever since we had Powell with that pivot, we are now expecting that to be reined back in, and the expectations have dropped off tremendously as far as future rate hikes go. And when we look forward, we're looking at possibly right now, many have just seen 1 rate hike for next year. So this data can be very key, because if inflation does drop down even further, that's going to make the Fed's job a lot easier and remain accommodative.
Yeah, naturally, people are linking Trump's comments to the change of heart from Powell and the Fed, but I think it's quite safe to say that my viewpoint, and I'm sure many people share that as well, is that Powell's comments, I think, were largely misinterpreted a couple of months ago at the start of October. I don't think there was ever a suddenly extremely hawkish viewpoint from within the Fed. I think it was probably badly communicated from someone who has only recently become Fed chair, and therefore isn't used to such incredible levels of scrutiny on every single word that you say. So I think he's clarified this, but I think also in the last month or so, the situation has changed. We are seeing a market that is in decline at the minute. We are seeing an economy that is the outlook for which is being revised lower on a regular basis, certainly from this year's levels. And we're also seeing a global economy which people are talking about as being softer next year. So when you take all this into consideration, it's not necessarily a surprise that we are seeing expectations for rate hikes from a central bank, which has already raised rates a number of times and is near the end of this kind of tightening cycle, at least for now, tapering back these expectations. And like I say, the surprising thing is that December, which was such a guarantee, is now still quite a strong possibility, but nowhere near the guarantee that it was. Like I say, 76.6% currently. But even if we look to December next year, which is what you alluded to just now, Ed, we're actually near on a 50-50 chance of a single rate hike in the next 12 months. That's quite a shift from a market's perspective, wouldn't you think?
Very much so. And the Fed, they've always said it, data dependent. Well, the data has been softer. So it does make sense. And taking a look at the rest of the world, we are seeing that slower economic growth really affect China, Europe, and eventually that will trickle down to the U.S. So the expectations for dovishness are growing globally.
Yeah, I completely agree. And what I really like about this chart here, actually on the CME Group Fed Watch tool, I think a number of these different platforms now have their own tool for Fed Watch. It's based on Fed funds futures and the movements that we're seeing there. Reuters has its own. I think Bloomberg has its own. This is just one which you can see on the CME Group website. And you can just see the change in expectations going into these meetings. So this is ahead of the meeting. And you can see that they're all just dipping lower. All these lines are heading in the wrong direction and having grown quite a lot now over quite a long period of time. And what was interesting is that we were in a situation whereby the markets and the Fed were very much aligned, but now it seems that there's that misalignment, because I guess the interesting thing from the December meetings, more so than the rate hike, is going to be that projection for next year. And the Fed, as you've alluded to, was talking about raising interest rates twice. Now the markets are 50-50 on one. You can see here, this is the one I was looking for, really, was the drop off in the expectations that we've seen for an interest rate hike. now in December, and that's being reflected across the entire futures curve. That's one of the reasons why we are seeing the inverted yield curve as well, which is another thing that has really shaken the markets recently, and another thing as well that the Fed is surely going to be paying attention to, because the last thing the Fed wants is for market participants to be increasingly fearing a recession, because that takes its toll on equity markets, it takes its toll on market sentiment, and these things can ultimately in many ways become self-fulfilling, and that is a dangerous position to be in. Heading into the rest of the week, we have the ECB decision on Thursday. Myself and Ed were having a little chat about this prior to the start of the webinar, and I think in many ways this hasn't been highlighted enough, the fact that this is happening on Thursday. I think many people are in a way overlooking it, even though the ECB is in a really interesting phase right now. This is one of the reasons why many people are turning more bearish on the US dollar right now. A lot of people thinking we're coming towards the end of a kind of dollar bull super cycle, and one of the reasons is because we are towards the top end of where the US is going with interest rates, but we're right near the bottom end of where other central banks are. And the ECB is, despite the slowdown in the economy that we've seen this year, and despite the fact that inflation has tempered a little bit, we are still expecting ECB to end its quantitative easing program this month. I don't think there's going to be any shift in expectations here. But previously, the ECB was alluding to a rate hike, the first rate hike in a number of years, since 2011, I think, and towards the end of summer next year. Now, I think they could push that back to the end of the year, at least, because of what we've seen recently, which would represent a real shift. There's a lot of people talking about the prospect for more TLTROs over the course of the next 6 months as well. I think this could be more interesting the next few months for the ECB than what people think. What's your view, Ed?
Well, expectations are for this meeting to see Draghi reiterate his stance that QE will end this month. The rate hikes, they might tweak that language, but after next summer, could be the winter. It could be much further. We are still seeing above trend expansion. So even if the forecasts do some moderation in their growth, the ECB is going to also be more wait and see possibly. So I completely agree with you on that front.
So that then takes us on with the week. We've got the press conference, of course, to follow, but again, I think that's very much remaining on the same theme. And then we've got a lot of data on Friday, as well as the PMIs, industrial production, retail sales from China. I think this could be quite an interesting day, actually, from an intraday volatility perspective. And we've got things like retail sales. Like, you can't underplay really the importance of retail sales in the US. This is very much a consumer-driven economy. Services represent more than 3/4 of the US economy, of which I think around half of that is consumer spending. So we can't really underestimate how important this data is for signaling the real strength, the real backbone of the US economy. And then we've got a selection more that follows as well. So we could see a nice little bit of intraday volatility here. And again, worth stressing the importance of liquidity this time of year as well, because as we've seen in the pound, which we'll note in the charts shortly, we've seen a lot of excessive volatility in certain charts recently, and I think that plays into the fact that we are moving into an increasingly illiquid environment. And I think the next 2 weeks heading into the Christmas period is really going to highlight, with such a major macroeconomic event like Brexit ticking on in the background and the risk around that growing considerably. And on that note, let's head into the charts and see where we're stood here. Ed, by all means, please do speak up if you have a chart of your own which you want to share, and I will flip this over to you. Otherwise, as well, don't let me jabber on. Feel free to interrupt if you've got a view, especially one that differs from my own, that you want to share with everyone. Otherwise, I'll pop over to you whenever I need a glass of water or something. So yeah, Euro's not really changed since we've since the last webinar, really. We've still got this situation whereby I think we're seeing a bit of a bottoming pattern here, which very much is conducive with the kind of end of the dollar bull run, which I was alluding to previously. From a purely technical standpoint, we're looking at a situation where we've got this kind of inverse head and shoulders that's formed. For me, again, it's not perfect, but for me, the neckline looks around this kind of 114.50 levels you've seen on a number of occasions now, starting in early November, but then progressing again. We've seen that 114.50 offer some significant resistance for the pair. You've got the shoulder here around the 113s, and you've got the tip, the head around 112. If we can see a hold or a close above that kind of 114.50s, I think that could be a nice little bullish signal. And I know I've got the fib levels on here, but that's just highlighting notable levels. And I know it looks a little bit messy. That's just highlighting notable levels from my perspective. The orange fib is an old one, which I might even remove, to be honest, because it's effectively served its purpose, just showing that really the dollar run that we've actually seen for most of this year has against the euro has actually just been a retracement from the move which we actually saw throughout 2017 in the euro. So it's going to be the fact that we're holding up around that 61.8 fib always adds that extra little bit of support around these levels. So yeah, I think if we can see a breakthrough that 114.50, that for me would suggest that this gaining traction to the upside, and with euro representing around half of the dollar index basket, that would be a bit of a bearish signal for the US dollar. What do you think, Ed?
Great, and if we could just switch over to my charts, I'd like to highlight one of the possible setups that I'm potentially eyeing here. And
do that. This is showing that. Still getting used to this whole partnership. The passing of screens. Perfect. Hopefully you should all see what Ed is now showing you.
Okay, great. So basically you pointed out that euro dollar has been pretty sideways. It's when you take a look at some of the volatility we've seen with some of the other pairs and the major indices, has not really been too exciting, but we are approaching some very key levels. And right now I'm taking a look at that 114 level. Currently the 50-day SMA is right around that area. And if we do see a little breakout here to the upside, my charts right now are displaying a potential bearish Gartley pattern. So one of the things that I practice and use every day is pattern recognition. And what we can see right now is that you'll see all these patterns constantly occurring in various time frames. Right now we're looking at the daily chart, and if this pattern is valid, what we could see is that the markets could make a run. If we do take out that 114 to 114.50 area, we could see a run up towards that 116 level, and it's right around that level that we could see that bearish Gartley pattern come into play. And what that would signify is that there could be an opportunity where price would then reverse back down. It's not targeting a major reversal back to the lows. It's just targeting, some traders would use this as an opportunity to take profit on a euro long position. If you're a dollar bull and you just want to ride that strong US economy, and if you're expecting that once this trade war is all resolved, that we could see another last thrust for the US dollar, you might look to re-enter your bullish position at 116. I think along with Craig, we're a little bit more on the bearish side for the US dollar looking into next year. But so this is identifying where you could look for some take profit if you are long, and if we do see that move up.
Yeah, I mean, I think that's a really good point, and it's always nice when the analysis actually comes to similar conclusions. So, for example, you talking about that 116 level would actually be conducive with the more conservative projection from the inverse head and shoulders pattern as well, because you've got the neckline coming in around the 113. So the shoulder coming in around 113, the neckline around 114.50. So that's around 150 pips. That gives you a possible price projection around that kind of 116 again, which again coincides with the 61.8 fib here, offering potential temporary resistance. So yeah, I think really good point there. And that particular the Gartley is something that I don't normally utilize. So it's really interesting to see that utilized on this chart. Moving on to cable. I mean, where do you begin? It's chaos right now. The pound is so volatile. so volatile. And we've seen the reaction yesterday was really quite significant. And the reason why it was significant is we were having a chat on the desk about what exactly is the worst scenario here for Theresa May. Was it to lose the vote in the Commons heavily, or was it the removal of the vote altogether? And for me, I actually believe that the removal of the vote altogether almost removed some of the leverage which we should have taken to Brussels, because I think a heavy defeat would send a stronger message. I wonder whether she was covering her own back to an extent, a heavy defeat being personally bad for her premiership. And I think that's maybe one of the decisions she's taken when removing the vote itself, in the hope that the EUC think this represents heavy opposition, and views the tapes of her being lambasted heavily in Parliament. Either way, the markets really did respond badly to that when it took us through the 127, 126.50 zone, which we've highlighted in previous webinars here, which is quite a significant move from a technical standpoint. We've gone through long-term support now, a cluster of support here over the last few months, but long-term support as well. We closed below there, which is significant as well. We touched the kind of 125s. We are retracing a bit, but I'm reading nothing more into this than a correction, a pairing of those losses. This, for me, is looking bearish in the near term, and with good reason. From a fundamental perspective, it feels like there's far more that could go wrong for Theresa May and her Brexit plan, and therefore the pound right now then could go right. So I think the technical move here is very representative of that. And when we're looking for new levels, near term at least, 123, 123.50 really does look very feasible as far as I'm concerned. And in terms of the Brexit process, then from there on in, the options that are open just seem to be numerous. The clear ones, the ones that stand out, would be for Theresa May to come back with a deal that satisfies Parliament. We have another vote and that goes through. I see that as probably amongst the more unlikely, but very much plausible. My gut instinct is that the EU may try and call the bluff and see what happens there, because from their perspective, if she comes back to Parliament and says we've got nothing more, this is the final deal on the table, people may vote very differently when it's a choice between this or no deal Brexit. But also the EU may do it because they view that the no deal is still not a feasible option, because rather than no deal, Parliament may then take another approach. We could see a leadership challenge within the Conservative Party to unseat May if they get the 48 letters. I think that's highly plausible. We could see an election, a challenge for an election, which would start with a vote of no confidence in Parliament, with the DUP abandoning May because of her deal, which would achieve the more than 50% needed to start the process of a no confidence vote. And we could see more rallying for a second referendum, which would surely benefit the Remain campaign, but also the EU as well. So it's going to be a very volatile time. And like I say, one of the four options I've named there would be positive for the pound, I feel. And in the near term, obviously a second referendum and Remain ultimately would be the most beneficial from a pound perspective, but I don't see that as the more likely option compared to the other two. So I think there's so much to factor in here. Again, Ed, from your side of the pond, how are you viewing this? How are you looking at the pound right now, and what do you think of the way the situation's unfolding?
Currently, the situation is right now it's a lose-lose for both the EU and the UK. And as you broke down, all the potential scenarios, it seems that the hard exit is the one that is scaring the markets the most. And as we see the talking heads say the probabilities are going much higher, that's always been on the table. And as we get closer to the never-ending deadline for finalizing this Brexit deal, as that risk goes up, we are seeing the currency be weighed down tremendously. And right now, it's all about the negative catalysts, whether it's confidence vote, leadership challenge. If we do have a general election, all these risk scenarios are going to possibly take the British pound lower. So right now, just focusing on some of the major key levels, the lows that we made a couple of years ago, we are looking at possibly, 124 as key support, 120 as the next major level. But everyone is right now focused on Brexit. It's a major risk event that could bring down Europe. At least when I say bring down Europe, really affect a lot of the numbers, GDP going forward for 2019. And whenever you have Europe struggling, it's really tough for the rest of the world to thrive. So most of the scenarios right now are looking pretty bearish. So once you start to see that trade overly crowded, we are prone to see short covering. So it's something that for British pound traders, you have to be nimble.
Yeah, it's a shame we don't have a reliable Brexit probability tracker, to be quite honest, because at the moment it's a lot of rhetoric, and it's all every single person seems to be trying to piece together the numerous and constant flow of information which you're receiving and trying to make sense of it amidst all the political noise as well. And believe me, I watched pretty much the full 3 hours of Theresa May's appearance in Parliament yesterday. My word, there was a lot of noise and a lot of nonsense and very little substance in the aftermath of the first few questions. So it really can be quite a headache, I guess, going through that entire process. Now, I know that that we're covering less in terms of charts in this week, but with having the two of us giving alternative views on a few different things, I'm going to move through some of the less interesting charts quite quickly, because there's no point in going over the same old stuff. So Euro sterling, we had a nice little break to the upside. We went through 90 yesterday, which was technically very significant, but I'm wondering which again coincides with the sterling move, which we saw on the pound dollar chart as well. We are finding support around there now, which is typically a confirmation signal. I think there's potential for upside moves here. Again, in the short term, I think the downside risks for the pound are far, far greater than the upside. And this has been brewing. Like I said, we had a series of higher lows, and we had that flat top around the 89.30s. Once that broke, it broke with some aggression. So that move to the upside isn't a huge surprise. It's nice to see it out the range, but ultimately this hangs on the headlines and the progress that we'll see over the next 2 weeks. But that's not to say that what we're seeing signs of in that chart isn't short-term fundamental weakness for the pound. Again, Ed, please do hop in if you've got anything to say. I just want to rattle through a few of these charts to see if there's any update. And I know you've got one yourself which you want to introduce also, which I don't typically cover on these. So it'd be great to get your insight. For those of you who are listening, Ed's got some great insights on the dollar Swissy chart. Again, one that I don't personally cover. So it'd be really good to get that in here as well. Aussie hasn't really changed. We have seen a bit of a pullback here, but we're still around the 50.61.8 fib level. So I'm still relatively bullish here on the near term. I do think this is a short-term correction. I don't see much of a dollar case for this, even if we are seeing weaknesses in the Australian economy, and we have seen warnings, for example, with regards to the Aussie housing market. I think if we break through the 71.50s, then perhaps that would give me a strong signal as to otherwise. But from my perspective, I'm still liking this initial breakout from the falling channel. I don't think we've seen enough of a bullish run here, and the fact that we're holding around these levels does suggest to me that this isn't a bearish looking chart as of yet.
And just to add, once we do see more progress on this trade war front with the U.S. and China, Aussie dollar is going to be probably the currency that benefits the most. So, looking at on the bullish side, this could be one of the better opportunities for the high beta currencies to show some significant gains once we do see some more progress on that front.
Yeah, it's a fantastic point, because it's not just the Australian, it's not just the fact that positive trade talks are good for bad for the US dollar, because the dollar was seen as the safe haven throughout the escalation of this trade war between US and China. But the Australian dollar, obviously the Australian economy is tied quite closely to the Chinese economy because of its mining industry, the natural resources that it sells to China. So when the Chinese economy is strong, the Australian economy tends to benefit as well. So yeah, I think that's a really fantastic point. So that takes us swiftly on to dollar CAD, and we have continued to see this build. You'll see that this little dip below the trend line last week, not reading too much into this, because you'll see that this was actually Monday and Tuesday last week. This is when we had the positive trade talks with China on the Monday, which was reported, which was dollar bearish, as we've just alluded to right now. And then Tuesday, we saw risk aversion in the markets once again, and this did pop higher. Interestingly, as again, me and Ed were having a chat beforehand, the Bank of Canada is expected to still raise rates next year, but it's gone from expectations of potentially December to push back to January. And now a rate hike isn't really fully priced in until around July. And as Ed was telling me, there's a strong possibility for May. So expectations being pushed back in Canada along with the US. But I guess, Ed, one of the benefits that the Canadian Central Bank has got over others is that it is ahead of the curve in the cycle.
Very, very much so. And I think right now everyone is tracking oil prices when you talk about the loonie, and it's struggling to stay above 50. So if we do see that level give, there could be a little bit more pain ahead for the loonie. But on the monetary policy side, yes, the Bank of Canada has been ahead, and the data has. The data will warrant future hikes in 2019. It's just we're at a rough patch right now.
Yeah, and if you're looking for a currency that's going to do well against the US dollar, this wouldn't be one of my favorite ones. Like we're both quite dollar bears. We're pretty much dollar bears for the next 12 months. And when you're always looking for two sides of the trade, right? So you're looking for what can do well against a currency that's expected to do badly. But again, the Canadian economy is so tied to the US economy that this isn't necessarily, from my perspective, the best pair to be eyeing up. Would you agree?
Very much so.
On that note, I'm going to skip through the sterling CAD quickly because it's messy, very, very messy. If you want to, from a Brexit perspective, it's so volatile, it's so choppy. I'm just going to move on from this because I don't think there's anything in that chart that tells me anything that I don't already want to know or that interests me in the slightest. So if that's what you came here to watch, then please do chirp up and ask any questions which you've got on that. But if not, I'm going to move on because it really doesn't interest me as a chart. Kiwi dollar I think is really interesting. We've had such a lovely move from this falling channel, but now I'm wondering if we are going to see some temporary reprieve because it's been such an aggressive move to the upside. We've really achieved these levels on quite a quick basis, but momentum seems to be lacking. We are seeing it on the MACD histogram here. We've seen two lower highs consecutively, and we're trading in negative territory on the histogram. We've seen lower highs on the moving average bands, which again is a bullish divergence at a time when price is making new highs, and even the stochastic is looking soft as well. This is coming around those 70 levels, so we could see another push higher towards that 70, but I really wonder just how much further this is pushing. Nothing about these momentum indicators tell me we're going through 70 and through 70.50, so a correction may well be on the cards and coming around this. It's interesting, this moving average pivot, actually, because we've got the 200 and 233 day here. We ran into resistance around the 200, then we broke above it, then we've rotated off from a closing perspective the 233, and now we're finding support. So perhaps this is a bullish signal in the longer term, and perhaps we can see 70 achieved. But with the momentum indicators as they are, I'm not overly bullish beyond that. Have you got anything to add there, Ed?
On the short-term side, 68.50 is going to be key support. So if we do hold that level today, I do think we could make another attempt for fresh highs here. 70 though, it will definitely be a key resistance there.
And then we move on to the yen pairs, and then I will pass over to Ed to give you his Swissy insight. Again, we're not going to spend too much longer on these because nothing's changed. So unless Ed's got anything to add, in which case, again, Ed, please do just speak up. We'll move swiftly on with these. I really want this dollar yen to break lower, and until it does, I'm not that interested because that lower highs are still continuing to materialize. So we're not seeing any upside move. If we break through this 114, then perhaps I'll be eyeing this 114.50 with incredible interest. But until then, I think the downside is looking weak. I think we're on a unsteady floor, and I think we can break through these 112s, 112.50 range, taking out the 112.30s in the process, taking out the moving averages, taking out the Ichimoku. I think this can look really weak, but until then, there's no reason why we can't consolidate.
And since October, we have seen a triangle pattern where we've really respected both the upper and lower boundaries, and as far as breaking out, right, we're right in the middle of the range right now. So I completely agree with you. Looking for that key breakout, but it has been a rather lackluster pair for us.
Yeah, completely agree. Sterling is just extremely volatile. Interesting that we've seen a breakthrough those kind of 143s. So like euro sterling, I guess, in many ways, because this is effectively a risk currency versus a risk off trade, with the yen obviously being one of the key, from a currency perspective, safe haven currencies. We have seen a breakthrough here, which is a strong signal of negative Brexit progress. Unless we get a breakthrough 140, though, I'm not overly going to. Well, I mean, we may be bearish here into 140, but I think 140 could be an important technical support zone here for this particular pair. But again, it's like euro sterling. There may be short-term bullish and bearish signals, in this case bearish, but longer term, I don't think they're materializing into anything extravagant. But I guess, as with all of these things, it's not a case of just having an anticipation of where the chart's heading, right? It's about market timing, and market timing in the short term is not bullish in any way, shape, or form for this pair. And I think that's the key takeaway that I'm receiving. I'll take that silence as you agree, Ed.
Oh, I agree. Very much so. Sterling yen, great when you trade during the London session. It's not one of my more active pairs on my radar.
Not a problem. And euro yen, really frustrating. We did have a nice little triangle setup, and I was hoping that we'd get a nice strong breakout signal, and it's just infuriated me more, because not only did we not get a strong breakout signal, we've very much remained in a tighter range between 129.30 and 127.60, and we're showing absolutely no signs that is changing anytime soon. So you can see the top end of the near-term range here, which I will put in black. You can see the lower end of the near-term range right here, which I'll put in blue. If we see a breakout of that, then fine, but otherwise it looks like we are sideways bound for this particular currency pair. And on that, let's take you over to Ed and his dollar Swissy chart to wrap us up, because hopefully it's going to be far more interesting than any of those yen pairs that I've just shown you. So it's over to you, Ed. And by the way, please do send over any questions in the meantime. We'll come to them shortly after.
And you know, the yen crosses have been consolidating, as you know, as we pointed out early. You know, dollar yen, triangle pattern, euro dollar, just range bound. So we will see a breakout, but until then, we do have other pairs like dollar Swissy right now. You can see from the chart, it is.
Sorry, Ed, have you shared? You need to share your chart on the screen.
Yes, there we go. All right, can you see it now?
That's the one.
Beautiful. So right now we're taking a look at the daily chart for dollar Swissy, and you can see that, you know, since we did break down below the 50-day simple moving average, which is highlighted in purple, we are currently seeing weakness stall right very close towards that 98.50 level, and this is a key point right now where, if we do see price reach this level, we could see a bullish reversal. This would be a Gartley pattern, a bullish Gartley pattern, where we're looking for a possible major reversal, because this is on a daily chart. So if you are a dollar bull, if you are looking for an opportunity to buy the US dollar, this is one of the charts that is providing us with a possible key bullish reversal here for dollar Swissy. And you also see some confluence with the 200-day SMA, which a lot of times we could see price try to gravitate towards that area. So, you know, several traders will look for prices to possibly touch and respect that level. But if we do see a strong breakthrough, when a bullish Gartley pattern, whenever a Gartley pattern is invalidated, a lot of times we could see strong momentum continue off. So typically with these patterns, they're right. Great, you identify quick reversal, but typically you like to have a relatively close stop loss, because when they're wrong, you could see lots of key momentum can carry through on those signals. So just one of the key charts that is highlighting a possible bullish setup here for a US dollar pair.
Awesome, really good stuff. As I was saying to Ed again prior to this, yes, Swissy charts, just not ones that I tend to look at personally, but that's purely a personal thing. I have still not forgiven Jordan and the Swiss National Bank for that horrible decision a few years ago, which removed the floor from against the euro and caused absolute carnage throughout the markets. So not one of my favorite currencies, but so yeah, some really good analysis there, Ed. Thank you very much for that. And with that, we will wrap things up. Actually, no, got one question here from Peter Banda. It says, how does the fundamental analysis and the technical analysis come together that I can make a decision based on both to take a trade? Well, from my perspective, Peter, it's difficult to make a decision based on both. It's always nice when they do come together, but I like to take them differently. So, for example, you've got to remember that technical analysis I always see as more of a leading indicator. This is the market pricing in everything immediately. So it tends to give you an indication as to what market sentiment is towards a fundamental situation, whereas fundamental analysis tends to be done in the aftermath of things happening, and then people trying to work out why price is moving as it is based on the information which they have at hand. Now, it's always nice when all the information you have at hand coincides with your technical view. So take the situation with Brexit right now. You could see for quite some time that the market was reluctant to be short the pound. The market thought the Brexit was going to move positively. The market seemed convinced, really, that we were holding above these 127s, 126.50s, and it's almost like the market was saying, come on, we're waiting for this breakthrough, we're waiting for this thing that says that we're moving towards a deal so that we can push higher. But at the same time, while that was holding, the lower highs were coming into play because the case for it was weakening. So you can see here where I still think the market is bullish on a deal being done, but it's almost run out of time, and the negative headlines have continued to flow too much. So there's times when the technicals are telling you something that the fundamentals just aren't showing, and this is very much one of those cases. Now, there's times as well when the market is looking nicely bullish. Or, for example, let's take the US situation right now. We are seeing signs of weakness materializing. We are seeing the Fed rhetoric changing, but we're also seeing the charts are displaying signs of weakness for the dollar. When things coincide like that, that does just give people conviction in their views on the outlook for something, and it's always gives you more confidence in any decision that you make when the two do align. But that's not always the case. It's worth taking both pieces of information in singularity and trying to determine which one you find more useful. I would always personally rather believe that the charts are right and I'm wrong, and try and work out why my fundamental view is different from what the market is saying. From the Brexit perspective, I think it's a time frame difference, for example. So I still think we are going to see a Brexit deal go through, but that doesn't mean that we can't see a month of weakness. So that's where I think my fundamental view differs from what my technical charts are telling me as we speak. What do you think, Ed? Do you agree with that, or do you?
I guess I do differ a little bit in the sense of when I always do like to have my fundamental bias before I take a look at my charts. And one of the key things is you have to understand where are you on your fundamental analysis. So so right now with Brexit, that volatility is extremely high on cable right now. So your fundamental analysis will have to be able to withstand significant drawdown, significant swings. So typically with cable, not necessarily trying to trade that one fundamentally. That one I might be more looking for more technical setups. But when you take a look at some of the other currencies, you could start to see some of the daily fluctuations be more ideal for setups where they could line up. So when you're taking a look at Aussie dollar, when you're taking a look at dollar CAD, you could start to see some more opportunities where you will be able to identify a risk management plan where you could understand where your typical drawdown and fluctuations are. And always look to trade technically, though, as far as where are my entries, where are my exits, where's my stop loss placement, take profit targets. But I always do like to have that fundamental bias. What is driving the currency? What are some of the future outlying risk events that could affect that currency? Is it trade wars? Is it central bank independence being questioned? Is it softening economic data? And just taking a look at what we have coming out. What are some of the leading indicators that could suggest we could see data shift, or we could see a central bank have a major shift in their bias. So all of that is what we do and what we cover in MarketPulse. And typically, once I have that bias, then I'll take a look at the charts, see what is an ideal setup, because obviously I'm looking at the markets at different times than Craig is. Craig, more covering the European shift, I'm more of the America shift. So we'll see different setups, different times. So it's always a good to try to find out what works for you, and specifically when you're looking at the market. So you'll see that whatever works for someone might not necessarily work for someone else. So you just got to find that fine balance on what does typically maximize your strategies and approaches.
Yeah, I guess that kind of comes back to the conviction element of what I'm saying. It's always better when your fundamental analysis and the technicals line up. The next question we've got is, how regularly do you offer these webinars? Robert, these are conducted every single week. So this is every Tuesday, 12:30 UK time, 7:30 a.m. in the US, and that would be 8:30 p.m. if you're over in Singapore. And that is about as far as my time zone knowledge stretches. So hopefully you can work out, depending on where you are in the world, how that works for you. In terms of, isn't it best to avoid sterling pairs at this time? It very much depends on your own personal preference, to be honest, Robert. It depends on what your risk appetite is. There's plenty of people, I say plenty. I'm sure there's people out there who are really enjoying the volatility aspect of the pound right now, who are you looking at this and aligning it with their analysis of what is happening and enjoying the fact that we are seeing quite extravagant moves. There are others who have less appetite for risk than what we're seeing, who are put off by the fact that it's so headline driven, and by the fact that at any time of any day we can see a piece of news come out that can dramatically have an impact on price and shift it, which effectively makes forming a judgment on this from a purely technical standpoint all that more difficult. So unfortunately, like I say, I think from my perspective, it really is just a case of who you are and how you like to trade and what type of environment you like to trade within to determine whether sterling is best avoided or whether these are kind of optimal trading conditions. What do you think, Ed?
Very, very, I agree with you. Spot on there. And one of the areas, some traders, they say, well, how can I tell when the markets are settling down? And one of the key features I do look at is the Volatility Index, the VIX. So right now the VIX is pretty high. It's trading around 22. So if you're not willing to stomach the swings that you do see with cable, you definitely want to see the market settle down, and you will probably and also coming into December, we are entering that holiday period. So Parliament will have their recess. We will see thin conditions. So if you think the volatility is strong right now, you could see a simple little tweet provide a 50 to 100 pip move in no time for cable. So it's important to understand the conditions that you're in. But cable is providing some of the more exciting opportunities. But if it's not ideal for your trading plan, then definitely track volatility, track understand what is where we are in the Brexit cycle, and once that does settle down, you'll aim to find some longer opportunities.
Yeah, perfect. And in terms of that, I think that's all of the questions that we have. So from that, I will just start to wrap things up, I guess. Thank you very much, everyone, for joining us. As ever, please do join us again next week for the follow-up webinar. Actually, scrap that. Next week we do not have one. We're a little bit close to Christmas, so we will be going again from January. 1st of January again is for live account holders only. This will be a full hour session look previewing the month ahead. I will be joined by another guest speaker for that particular webinar. We'll take a look at certain charts and discuss the key themes, give a really insightful Brexit update, of which I'm sure there'll have been 1,000 different updates by then. In the meantime, just keep checking out the MarketPulse website. There's regular daily analysis appearing there. It's also where you'll find the recording of today's webinar. You'll also see the recording of last week's webinar, which went up a few days later with myself and Dean, the hour-long special that we did then, a little taster of what you can get if you are a live account holder on the first Tuesday of every month. that aside, you can also check out our new podcast series. So this is OANDA Market Insights. That is myself with Jazz FM every Friday, covering the key themes that week. We've also got OANDA Market Beat. That is Alfonso leading that podcast, which I will throw up here because I've been a bit slow. The OANDA Market Beat, that's released in the middle of the week, so that offers again a midweek assessment of what the key events are to keep an eye out for. And then hopefully we'll continue to increase our podcast series. I don't know about you guys, I listen to podcasts all the time. And a variety of different podcasts as well, both trading related, market related. The Times, I think, is always a good podcast, but then football and things like that, depending on what your interests are. So I'm a keen podcast listener, so we're trying to offer a series here which you guys can really get your teeth into and listen to on the commute and really match up what we can provide with what you would like to have. So all feedback is always welcome, so please do leave reviews and everything, and let us know what you think of them. Also on Twitter, so you can find us. My username is Craig_Forex. Ed, are you on Twitter?
Yes, I am. At Ed J Moya, EDJMOYA.
Perfect. And do reach out to either of us if you've got any questions about what you've seen today. Please do reach out and say hello. Ask any questions that you've got that you didn't think of during the actual webinar itself, and I'll always reply to any questions that you've got. But apart from that, again, thank you very much for joining us. I hope you really enjoyed it. I hope you got plenty from it, and I hope to see you again very soon. I wish you all the very best of luck with your trading over the rest of the course of this month, and I hope you all enjoy the festive period. Thank you very much for joining us. Catch you again very soon. Ed, thank you for joining us as well.
Craig, thank you for having me, and happy holidays, everyone.